Do you have crypto gains for this year and you're a real estate investor? Well, in this video, I'm going to show you how you can eliminate some of those gains by using your real estate to offset them. All right, let's get started. Okay, so here's the deal. I've talked to a lot of investors who also invest in crypto and real estate, and they do not understand the difference between how crypto gains are accounted for under the Internal Revenue Code and their real estate losses. Now, this is really important to you if you're investing in crypto, because you're probably using the crypto, and maybe you've already caught my other video on the crypto tax bomb that's floating out there for investors who use crypto to invest in real estate. Here's what you need to know about your crypto and how the IRS treats the gains, so you can then better understand how you can use your real estate to offset those gains. So here's the way it works. When you have crypto, okay, any gains from that is considered a capital asset. That means it's either taxed as short term if you've held it for less than a year. So any gains held for less than 1 year is short term. And any gains held for greater than 1 year is long term, okay? So that means you've held it for more than 1 year before you dispose of it or before you use it. So what I mean by that? Let's say I made an investment into some digital assets. Let's say I bought some crypto a year ago, and then I use that to turn around and purchase or use it for the down payment on a new property. All right, so this property over here, I'm going to use $100,000 of crypto to pay the seller for my down payment, and then maybe the seller's carrying the contract. So knowing your cost basis and when you bought it is really important here, because let's assume I bought this a year ago for $80,000. Okay, well, we know it'd be much more than that, but let's just, for purposes of this, we bought it for $80K. And so since I've held it for a year, then I will have $20,000 of imputed income to me when I pay with my Bitcoin for this property or use it for my down payment. Now, this $20,000 in gain, the question is it long-term or short-term? Well, because I held it for more than a year, it's considered to be long-term, and the long-term capital gains rate would be 20%. If it was short-term, then it would be taxed down to me at my ordinary income tax rate. So this is really important to understand how these taxes work when you're disposing of that, because if you're investing or using your crypto to pay for things, maybe it's pay for your rent, maybe it's, as I showed you, a down payment on a property, be sure to not only track and use those assets that have the highest cost basis, but also look at those assets that you've held for more than a year, because you want to balance that out and determine what is going to be my after-tax liability on that. For example, let's assume that I had another wallet that had crypto in it that I had a $95,000 tax basis in it. All right, and I use that $100K to make this down payment. Well, in that case, if I held it for less than a year, I have $5,000 in income. Maybe I'm in a 30% income tax bracket. So in this particular example here, I'd have a $1,500 tax liability. Whereas in my first example, because I'm taxed at 20%, I'd have a $4,000 tax liability. You're probably scratching your head going, what is Clint doing to me here? What I'm trying to explain to you is that if you are using crypto to pay for things, right, and you're paying in crypto, then you have to understand the tax side. You need to track your basis in those wallets, and you need to track your holding periods. So you're using those wallets or the crypto from those wallets that is going to create the lowest taxable gain for you. And it doesn't matter if you've disposed of it, it still plays the same way. Now, what does that mean? Okay, so here's the way it breaks down when it comes to crypto. So if you sell it, all right, if you sell it for a gain, that is going to be a capital gain. Okay, so it's either long-term or short-term. Now, if you're receiving staking awards, okay, so staking is just plain up income to you. Okay, whenever you receive any type of staking rewards, that's considered to be ordinary income. It is not capital gains. If you're earning interest on that or you're getting some type of yield, then that is also going to be ordinary income to you from this. Now, here's the thing to realize about all of this stuff here. This is all not passive. Now, this is where the real estate side is going to come in here in just a moment. None of this is passive. And oh, by the way, if you're flipping NFTs or you're trading it, well, if flippers, that could be either, or traders, again, for those people, that could be either capital gain okay, or income. So that's where it can get even more confusing here when we're trying to figure all this stuff out. But here's what you should be doing then. If you're investing in crypto, you need to look at ways, if you've disposed of it this year, know what your taxable gain is, and then find opportunities with your other investments to reduce that gain. So here's a simple example of what you might do. Let's say that you have your digital asset accounts, you've got some wallets there, and you've just used some of that this year. And from using that, you've generated for yourself $10,000, okay, in short-term gain. Okay, so you held the digital asset for less than a year, and then either you converted it or you used it to pay for something. So you have $10,000 in short-term gain, capital gains on the disposition of that. So how do I help reduce that from a tax standpoint? What can I do? Well, if you own real estate, okay, and you decide, well, this real estate over here, with my depreciation and my taxes and my insurance, it's showing a loss this year of $10,000 on paper. I'm just going to take this loss right here and I'm going to use it to offset my $10,000 gain from my crypto. Well, unfortunately, this does not work for you because in the Internal Revenue Code, the losses from your real estate are classified as passive. All right, whereas the income from your crypto is not considered to be passive to you that you can use then to offset this. This is considered to be active or considered to be portfolio income, which is slightly different. So you can't match these up. So your real estate is taken off the board. Now I'm going to show you a way to bring the real estate back onto the board where you can use it. So stick with me here. So then what do I need to do then? Well, here we are at the end of the year, or coming up on the end of the year. What you need to then look at is, hey, do you have a brokerage account? So many investors, crypto or digital assets make up just a portion of their overall portfolio. So what you should be doing then is looking to harvest losses from your portfolio. If you have some positions that are down, let's say I hold some stock in a company and it's not performing so well this year and I've actually lost value in that position. Maybe you go in and you sell some stock in that company and it generates for you from the sale of that. Let's say it was Coca-Cola. Now, I don't think that's down right now, but let's assume that it was. And you're able to sell this and you generate a $7,000 loss from the sale of that. Well, in this particular situation, because crypto is treated the same as your stock, all right, it's portfolio gain, you could use those losses. So what would end up occurring is you would take your $10,000 in gain that you have to recognize and offset it against those $7,000 in losses, which would leave you with only $3,000 in taxable income for the year. So it's a huge benefit, and it's something that people oftentimes miss. They don't necessarily associate the fact that, hey, my stock market or my stock account, okay, and that can't be one in an IRA or a 401k, that's not going to help you. But the one you have in your own name, you can use losses there to offset your gains from your crypto that are going to be imposed upon you, especially with all the new reporting rules that have gone in. And that's why tracking is so important right now. Okay, so what do we need to do if we're a real estate investor now? So the idea here as a real estate investor is we need to fix this. We need to work on these passive losses. We need to change them, convert them from passive, get them out of the passive activity rules and make them into something where they're non-passive and they can be used to offset the gains from our crypto. So there's a couple of different ways in which you can do this. Now, the first method we have here that may or may not work for you is to if you're a real estate investor, is to be a real estate professional. Okay, so try to become a real estate professional, meet that test, or what we call REPS test. Now, in order to become a real estate professional with respect to your properties, the test is really quite clear. It's just black and white. All right, here's what it requires. All right, to be a real estate professional, number one, you have to spend 750 hours on real estate related activities. Okay, so that's one prong here to be a real estate professional. The second prong of this requires that you spend at least 50% of your time on real estate related activity. Okay, so it doesn't have to be your real estate, all right? It just has to be in a real estate field. So you got to spend 750 hours plus 50% of your time on real estate related activities. And so sometimes people say, well, I'm a physician. Can I become a real estate professional? Doubtful. It will never work. If you have a full-time job as a physician, you will not qualify because 50% of your time, this prong right here won't work. I mean, you could spend 750 hours looking at real estate and working on your investments, but you still wouldn't meet the 50% prong test. So don't worry, I'm going to give you a solution for that as well. But if you can qualify as a real estate professional, if you're already in a real estate related field, then this is something you could use to convert your losses, and I'll show you what I'm talking about in a moment here, don't want to miss this, into something that you can use to offset the gains. So not only must you meet this test, then you have to materially participate, okay? So you got to do this other thing called material participation. And what that means is this is where we're going to look at your investing, okay? We're going to look at what you're doing on your properties. So essentially what we're saying here is you have to look at your property, my investment property, and I need to spend 100 hours on my properties. So it can be overall your properties. You have to document that you spent 100 hours working on those properties. And that could be working with people to lease them out, rehabbing them, whatever. As long as you're working on those and no one else has spent more time than you. There's not a single person you brought out there that spent more than 100 hours, then you've met this test. If not, then it's going to be a 500-hour test. So if you do that and you become a real estate professional, now you're going to unlock your real estate losses here. So if I have a piece of property and I have a lot of gain this year from my crypto trading or my use of crypto, then what you might want to consider is performing a cost segregation study on your property to accelerate the depreciation on that, and then use those losses to offset your income. Because before they were locked, now you've just unlocked them because you took them from a passive state and you made them non-passive. All right, I'm not going to go deep into the cost segregation and the bonus depreciation right now. I have other videos. You can search my channel for that. But this is how people do it. This is what we do on our tax side for our clients is we show them, hey, you got assets, you've got income. We're going to show you how to take those assets, create losses from those to offset that income. Yeah, it's going to require a little bit of work from you, but think of the benefits that you're going to have by creating these types of losses so you're not paying tax on that other type of income. Okay, so what about the busy professional now? How do you fit into this? Okay, so here's the other strategy we have if you can't qualify as a real estate professional. It's one that we've been using here at Anderson for many years that helped a lot of people, just like you, if you're watching right now, reduce their taxes. And that's called the short-term rental loophole. Maybe you've seen some of my videos on this. We'll just put STR, short-term rental. And here's what you're going to do with the short-term rental loophole. And it's a much more lax standard than that real estate professional status that I just shared with you. Because let's face it, most of us do not spend 750 hours and 50% of our time on real estate related activities. So in order to tap into those real estate losses and use them to offset the gains from crypto activities, then we need to take our properties and turn them into short-term rentals. Now, maybe it's not all of your portfolio, but pick one property, maybe you start with that. And as long as you can show that the average rental period for each of these properties is 7 days or less, all right? So you could have some stays that are 15 days, you have some that are 3 days, but as long as the average, right? You just average them all up. If there's 10 stays over the course of a year, and then you figure out how many days, it was 60 days, it doesn't matter how many that is, some was 15, some were 3, whatever it is, that means my average stay is 6 days right there. That's all you have to do. As long as you can meet this test right here, show that your average stay was 7 days or less, and you can show that you spent 100 hours, so again, we have that same material participation test here, just show you spent 100 hours on your short-term rental activity, okay, and that's more than anyone else. So let's say you have a cleaner that comes out every time there's a turn. Well, if that cleaner's spending 2 hours there or 3 hours to turn your property, you know you cannot use that cleaner more than 30 times just to give yourself a buffer. Then you got to get a different cleaner to come out there, right? Because you got to be above whoever's out there on the property 100 hours, right? No one can surpass you. You can have 10 cleaners working on your properties as long as none of them reach 100 hours for the year and you have it, you win this test. So now if these are short-term rental properties, I can do that same cost seg study on my properties, take that bonus depreciation. So maybe this property here, if I do it, it throws off for me $60,000 loss. Well, that loss now, because I've met the short-term rental loophole test, is non-passive. So if I have from my crypto 10K in gains, I can take this 60K in loss and offset it. Now I show zero taxable income from my crypto. All right, for real estate investors, this is an awesome opportunity. It's not to be missed. We're coming up at the end of the year now, and if you're looking to dispose of some of your digital assets, or you're going to be using them and you know you're going to have gain, let's look at those properties that you own to offset those gains. Now, if you want to reach out to someone here at Anderson, go into the show notes, click on the link to set up your free strategy session. And one of the professionals here can walk you through these strategies and how you can implement them before the end of the year. We've got more runway here to take advantage of this, to make sure you're paying the least amount of taxes as possible here in 2025.